Welcome to Market Watch Daily. I'm TMI, bringing you the latest insights into global finance, economic trends, and market movements. Today, we are diving deep into one of the most critical financial events of the month, the upcoming Federal Open Market Committee, or FOMC, meeting scheduled for March 18th and 19th, 2025. This meeting will be pivotal for interest rate decisions, economic projections, and overall market stability. Let's break down what to expect, why it matters, and how it compares to past FOMC meetings. Understanding the FOMC, the Federal Open Market Committee is the branch of the Federal Reserve responsible for setting monetary policy in the United States. It meets regularly to evaluate economic conditions and determine interest rate adjustments. The committee's decisions impact everything from mortgage rates to business loans, making its meetings a key focus for investors, policymakers, and consumers alike. The Fed's primary objectives, often referred to as its dual mandate, are 1. Maintaining stable prices, which means keeping inflation under control. 2. Achieving maximum sustainable employment. Balancing these two goals is a constant challenge. If the Fed raises interest rates too aggressively, it risks slowing the economy and causing unemployment to rise. If it cuts rates too soon or too much, inflation could get out of control. This is why each FOMC meeting is closely watched. Every policy decision sends ripples through the financial world, affecting stock markets, bond yields, currency valuations, and even global trade. Current economic context: the March 2025 FOMC meeting is taking place in a highly complex economic environment. Several factors are shaping the market outlook. Trade policies. President Donald Trump's fluctuating tariff strategies have introduced uncertainty into global trade dynamics. Recent threats of imposing a 200% tariff on European alcoholic products and retaliatory measures from the European Commission have heightened concerns about a potential trade war. If these tariffs materialize, they could impact inflation and economic growth, forcing the Fed to adjust its policy stance. Market volatility. The stock market has been experiencing major fluctuations, with the S&P 500 entering a correction phase after dropping more than 10% from its February highs. Investors are uncertain about how the Federal Reserve will respond to these economic shifts. Inflation trends. Inflation has been a major concern for policymakers over the past few years. While recent data suggests inflation has cooled slightly, core inflation, which excludes food and energy, remains sticky. If inflation persists above the Fed's 2% target, it could delay anticipated rate cuts. Interest rates. The federal funds rate is currently at a range of 4.25 to 4.5%. The Fed has signaled that it is in a wait-and-see mode, assessing data before making any decisions on rate cuts. However, financial markets are already pricing in multiple rate cuts later in the year. What to expect from the March FOMC meeting? Given the current economic environment, here are the key areas investors will be watching during the upcoming meeting. Interest rate decision. The Federal Reserve is widely expected to maintain the federal funds rate at its current level. While some investors are hoping for a rate cut, most economists believe the Fed will hold steady to gather more economic data before making any moves. Economic projections. The Fed will release updated economic forecasts outlining expectations for GDP growth, unemployment, and inflation. These projections will provide valuable insight into the Fed's long-term view of the economy. Dot plot. The FOMC's dot plot, which reflects each member's projections for future interest rate moves, will be closely analyzed. Any shift in the dot plot could indicate changes in the Fed's policy outlook for the remainder of the year. If more members see rate cuts happening sooner, markets could rally. Press conference. Fed Chair Jerome Powell's post-meeting press conference will be crucial. Investors will be listening for any signals on future rate cuts, concerns about inflation, and how the Fed views the impact of trade policies on economic growth. Historical comparisons. Looking at past FOMC meetings provides useful context for understanding the potential impact of this one. Historically, the Fed has been cautious about cutting rates too soon. In the early 2000s, for example, the Fed kept rates high longer than expected due to concerns about inflation. Similarly, after the financial crisis in 2008, the Fed kept rates near zero for an extended period before gradually increasing them. The Fed's response to inflation in the past 2 years has been aggressive, with multiple rate hikes aimed at cooling price pressures. However, with inflation now showing signs of stabilization, the central bank is shifting its focus toward maintaining economic growth. Market reactions and investor sentiment. The outcome of the FOMC meeting will have significant effects on financial markets. Equity markets, stocks often react strongly to Fed meetings. If the Fed takes a dovish tone and signals potential rate cuts later in the year, markets could rally. However, a more hawkish stance could extend the current stock market downturn. Bond markets, Treasury yields will likely move based on the Fed's stance. If investors believe rate cuts are still far off, bond yields could rise, affecting borrowing costs for businesses and consumers. Currency markets, the US dollar's strength depends on interest rate expectations. A more aggressive Fed stance could strengthen the dollar, impacting global trade and currency valuations. Expert opinions. Many economists believe the Fed will keep rates steady for now, but may start cutting rates in the second half of 2025. Some analysts caution that if inflation remains persistent, the Fed could delay rate cuts further, creating challenges for economic growth. Several investment firms, including Goldman Sachs and Morgan Stanley, have released reports suggesting that rate cuts may begin in June or July. However, they also note that geopolitical factors, including trade tensions and global economic conditions, could influence the Fed's decision-making process. Conclusion. The March FOMC meeting is set to be one of the most closely watched financial events of the year. With economic uncertainty, ongoing trade disputes, and inflation concerns, the Federal Reserve's decisions will have wide-reaching effects on markets and the broader economy. Investors and businesses should stay informed and be prepared for potential shifts in monetary policy. Thank you for joining us on Market Watch Daily. Stay tuned for more updates on global finance, market trends, and economic policy.